about to hear my conversation with Nicholas Tham, Vice President and Portfolio Manager on the Global Quantitative Equities team at Mackenzie Investments. We'll explore how low volatility ETFs can serve as essential tools for advisors and investors looking to reduce volatility without compromising equity exposure. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. I'm your host, Prerna Matthews, VP of ETF Product Strategy. Today, we're delving into the world of low volatility ETFs, and we'll discuss their increasing popularity during periods of heightened market uncertainty and how they've performed in various market conditions. Our featured guest, Nicholas Tham, Vice President and Portfolio Manager on Mackenzie's Global Quantitative Equity team, will shed light on Mackenzie's low volatility strategy and the investment process behind these ETFs. We'll explore how these products can serve as essential tools for advisors and investors looking to reduce volatility without compromising equity exposure, and share tips on communicating the benefits of these products effectively to clients. Nick, thank you for joining us on the podcast today.
Thanks for having me, Prerna.
So why don't we get started by explaining to our listeners the fundamental concept of low volatility ETFs and why they've gained popularity among investors, particularly in uncertain markets.
Great. So maybe let's start from the basics. So volatility is a measure of how risky an investment is. So high volatility ETFs would have big swings up and down, and low volatility ETFs would have more steady returns. And the traditional wisdom stemming from the capital asset pricing model, which gained popularity in the 60s, was that investments which are more risky also give higher returns. So people used to think that if I want to make more money, I got to put my investments in riskier assets. And that was the traditional wisdom. And then came along this whole idea of the low volatility anomaly, which academics started identifying in the 70s, where they pointed out that you could have an equity portfolio that has lower risk than the regular market portfolio and still have higher return. So that's kind of counterintuitive to the traditional wisdom, and that's why it was called the low volatility anomaly. And this really started gaining popularity in the 2000s, and ETFs started to encapsulate these ideas, and MSCI's US Min-Vol Index ETF, which was launched in 2011, was one of the very first products that hit the market. So just to illustrate some of these numbers, so just looking at the MSCI World Minimum Volatility Index from the turn of the millennium, beginning of 2000, until the end of last month, August 2024, during this time period of about 25 years, the annualized return of the minimum volatility index was 6.7% every year. Then that's almost a whole percentage higher than the MSCI World Index, which is the standard market index, which had a return of 5.8%. So almost a whole percent higher than the market return. And if you look at the volatility measure, the MSCI World had a pretty high volatility of 18.9%, and that's compared to the minimum volatility index, which came in only at 12.5%. So a lot less volatility, a lot less risk, and yet a whole percentage higher in terms of return. So that's why in the recent years, low volatility ETFs have started becoming more popular.
Thank you for that context, Nick, and really for setting the stage for our conversation. But not all low volatility exposures feel and look and perform the same. And, I think over the years, as we've seen more interest and more investors seeking low volatility investment solutions too have seemed to have evolved. So can you walk us through the specific investment process that your team at Mackenzie uses in its low volatility ETFs? What sets them apart from other low volatility products in the market?
So different providers have different approaches to low volatility products. Some just try to give you a portfolio which has the lowest possible volatility using equity exposure. For us, we try to target the MSCI minimum volatility index, whether it's the US index, the world index, or Canadian index. We have a few different offerings, but we try to target the performance of the index and then try to outperform that. So we have what we call an alpha model, which tries to pick the most attractive stocks in our universe and then try to build a portfolio that performs similarly to the low volatility index in terms of risk characteristics, but consistently outperforms that index by a few percentage points every year. So the alpha model aims to outperform the index, and risk controls keep total volatility below that of the index. And another advantage that we have is that we have access to the entire universe of stocks, which is different from some of our competitors, who might shy away from slightly riskier stocks. We can invest in those stocks as well, even though it's part of a low volatility strategy, but we use our portfolio construction or the choice of how much we invest in each stock to build a portfolio holistically that even containing some of the risky stocks has the characteristics of a low volatility index.
Can you tell us more about some of those key factors or metrics that perhaps go into that alpha model?
So the alpha model we use for the low volatility strategy is the same as the alpha model for our other standard core products, which are obviously of higher volatility. So key factors are value, growth, quality. So these are the main styles that we invest in. And within each of these styles, we have some factors, for example, long-term growth of a company, which looks at the long-term prospects of how companies would grow. So companies like Nvidia or any of the big tech firms today, Google, Microsoft, all of these have very large long-term growth prospects. We also have some more cutting edge metrics like fundamentals predictions, where we use machine learning algorithms to predict what the fundamentals of a company are going to be, things like sales, earnings, or dividend yield. And we compare those predictions to what analysts are saying in the market. And if our predictions are higher, we see that as a bullish signal for the stock. And all while doing all of these and looking at what stocks are attractive based on all of these metrics, portfolio construction once again keeps the risk of the portfolio in check.
So the process is clearly far more than just ranking stocks by lowest volatility and selecting those. And so, how has that then translated to how your team's approach has done in different market conditions, particularly during periods of heightened volatility?
So we like to think of it as two separate pieces. One is what we consider alpha, or how well we have performed relative to the low volatility index. So in the alpha space, we have performed very well. We have outperformed in every single year since our inception in 2020. And part of this is because of our core approach. By having balanced exposure to our three main styles, value, growth, and quality, we're able to deliver consistent alpha in different market conditions, even this throughout COVID, the recovery from COVID, the inflation crisis. All of these have been very challenging investment environments, and yet we've been able to outperform in all of them. The other piece is what we consider benchmark performance, or beta, where we can compare how the low volatility index or minimum volatility index has performed relative to the regular market index. So if you look at, say, for example, the MSCI World versus MSCI World Min Vol Index, in the long run, as I mentioned earlier, the minimum volatility index does tend to outperform, but in big up years, the low volatility index would tend to underperform. So when the market is rallying strongly, the low volatility index struggles to keep up. But on the flip side, when there are big down years, like in 2022, the MSCI World was down 18.1%, but the minimum volatility index was only down 9.8%, so almost half of that. And another point I want to point out is when there are big drawdowns. So, for example, from the beginning of July to the 5th of August, the MSCI World experienced a 6.4% drawdown. The minimum volatility index only experienced a 2.7% drawdown. So when there are big crashes in the market, this minimum volatility index can really help protect you.
That's a great point for our listeners. While low volatility ETFs are designed to reduce that risk, but how do they balance this with the potential for returns? You spoke briefly about this in terms of the alpha model. Can you tell us more about how that is exhibited then in sector exposure, for example? Like, how does that translate ultimately to what is held in the portfolio?
So, by nature of construction, the minimum volatility portfolios tend to be overweight defensive sectors and underweight cyclical sectors or more aggressive sectors. So, sectors like tech are traditionally underweight. Sectors which are more steady, like utilities, will be traditionally overweight. And in terms of how they're designed to reduce risk, you mentioned how do investors balance this trade-off between risk and return. And there, I think, lies the beauty or maybe paradox or anomaly is that there is no trade-off. You get to have your cake and eat it too. You get higher return with lower risk in the long run. So I think that's the big attraction for a low volatility strategy. And especially when there are big drawdowns or um, big market crashes, you really have that protection there. On the flip side, it does tend to underperform during big up years. So I think in terms of balancing, I think you need to have a little bit of both.
Great points. So, for our listeners, let's switch gears a little bit now and talk about the allocation to low volatility strategies within a diversified portfolio. What role can low vol exposure, low vol ETFs play? How might advisors, investors incorporate them alongside other asset classes or strategies to optimize their overall portfolio performance?
So I mentioned earlier downside protection. I think that's number one. That's key. Also, lower correlation to the standard market return helps you get more diversification. The low volatility ETF doesn't perform that similarly to the market return. They are correlated, but the lower correlation gives you better diversification, a better Sharpe ratio or risk adjusted return altogether in a portfolio that has a bit of both. So you should have your standard market exposure to capture the big up years. At the same time, you should have an allocation to low volatility, and that acts as a defensive play. And together, the combination of that will give you the best risk adjusted return. Low volatility also gives you market exposure in a far less volatile way than a standard core ETF would. And another point is that if you have a client who is more risk averse and shuns equity exposures altogether, this could be a good way for them to get some equity exposure without the full volatility or risk of a standard investment into the market index.
That's great insights, Nick. Now, looking at it from the lens of advisors communicating these benefits or discussing low volatility ETFs with their clients, any final tips, words that you can provide on effectively communicating those benefits, potential trade offs, if any? As you pointed out, that's not always the case. You've certainly highlighted risk many times on our call today. Are there any other tips or key points that you believe are important to highlight for advisors with clients?
Yes. So I think clients and advisors are often worried about when investments underperform. So maybe I can talk a little bit about when low vol might not work as well as a standard market investment. When there are big up years, when the stock market is rallying really hard, a low volatility ETF would not perform as well as a standard market ETF. When the appetite for risk is increasing. So, for example, when risky stocks are doing particularly well, if you think about a couple of years ago when GameStop and Bitcoin were rallying like crazy, that's not really the bread and butter of or the strength of a low vol ETF. Low vol ETFs tend to capture slow and steady companies that eventually in the long run tend to outperform. So, back to the old adage, slow and steady wins the race. That is true in the long run, but in the short run, there are times when the rabbit bursts ahead. So that's when the low vol ETF would tend to underperform. So I think, like all things, having a diversified portfolio is key, and having a little bit of the low vol ETF for good defensive equity exposure alongside a core ETF for capturing those big up years, for capturing when people are have great appetites for risk. I think the combination of that is the best place to be. Boring stocks, which nobody seemed to talk about, eventually do provide better returns, but diversity once again is king.
Those are great tips and takeaways for our listeners. Nick, I'd like to thank you very much for your time and for sharing all of those valuable insights today.
You're welcome.
That brings us to the end of this episode of The Invested. We've just learned about how and why low volatility ETFs have gained popularity, particularly in uncertain markets, by offering downside protection and reducing portfolio risk. Nick walked us through Mackenzie's approach to constructing low volatility portfolios, emphasizing the importance of risk controls and various factors to outperform traditional low volatility benchmarks. Finally, we touched on the importance of positioning these ETFs within a diversified portfolio to optimize returns. For advisors and investors looking to reduce volatility while maintaining market exposure, low volatility ETFs offer a strong defensive play and better risk-adjusted returns over the long run. Thank you to our listeners for tuning in. We hope this episode has provided valuable insights to how low volatility ETFs can be a powerful tool in navigating market uncertainty. If you have any questions or topics you'd like us to cover in future episodes, please reach out via our blog or through LinkedIn. Until next time, stay invested. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income tax payable by any security holder that would have reduced returns.